Are we on the brink of a financial apocalypse? The current consensus on platforms like X suggests that stock market valuations are experiencing significant overvaluation, with some users posting that the market could be as much as 30 to 40% overvalued. This perspective is often linked to macroeconomic policies, particularly the Federal Reserve's actions, which some describe as having created a bubble through digital money printing. There's a sentiment that this overvaluation surpasses even historical peaks like the dot-com bubble, fueled by factors like low equity risk compensation and high stock prices relative to GDP. A stock market bubble refers to a period where the price of stocks or other assets rises to levels far beyond their intrinsic values, driven by exuberant market behavior, overconfidence, and speculation rather than solid economic fundamentals. This often leads to an unsustainable market condition where the bubble eventually bursts, causing a sharp decline in asset prices. The most famous examples include the dot-com bubble around 2000, where excessive speculation in internet-based companies led to inflated stock prices, which eventually collapsed when the expected profits did not materialize. Similarly, the 2008 housing bubble resulted from overly optimistic housing price expectations, easy credit, and speculative buying, culminating in a financial crisis when the bubble burst, leading to a global economic downturn due to the interconnectedness of financial markets. The current economic climate presents several signs that experts and observers, including those discussing on platforms like X and in economic reports, suggest could indicate the formation of bubbles in various sectors. Posts on X and recent analyses suggest a worrying trend in real estate, particularly in areas prone to climate change impacts like flooding and wildfires. Property values in some regions are seen as potentially overvalued due to the risk of natural disasters, which could lead to a devaluation if insurance becomes too costly or unavailable, similar to what happened during the 2008 housing bubble. The U.S. equity markets show signs of being overvalued, with discussions on X pointing towards a concentration in tech stocks, especially those involved in AI and other high-growth areas. This concentration, alongside high valuations not always justified by fundamentals, echoes the conditions before the dot-com bubble. The S&P 500's behavior and the mentions of dealer inventory positions reminiscent of the 2007 period further fuel this concern. Significant debt accumulation in both public and private sectors, highlighted in economic reports, suggests another area of concern. High levels of personal debt, especially from student loans and credit cards and corporate debt, could lead to a credit bubble. If economic conditions worsen, this could result in a wave of defaults, reminiscent of the subprime mortgage crisis. Fluctuations in commodity prices and the speculative nature of cryptocurrencies like Bitcoin have been mentioned as potential bubbles. The rapid rise in Bitcoin's value, for instance, has been compared to historical asset price bubbles where speculation outpaces intrinsic value. The monetary policies post-2008, including low interest rates and quantitative easing, have led to an influx of liquidity in the markets, which some argue has inflated asset prices beyond sustainable levels. This is coupled with government spending cuts and deregulation fears, which could either mitigate or exacerbate bubble conditions, depending on their implementation. There are mentions of sectors like healthcare and education experiencing disproportionate growth in costs compared to inflation or economic growth, suggesting these might be forming bubbles. The cost of higher education, for example, has dramatically outpaced general inflation rates. The sentiment on platforms like X reflects a general concern about these bubbles potentially leading to economic instability if they burst, possibly due to triggers like geopolitical tensions, a major banking crisis, or if the underlying economic conditions shift unexpectedly. However, these observations also come with the caveat that not all bubbles burst with the same impact. Some might deflate slowly while others could lead to more drastic economic corrections. This overview should be viewed with a critical lens, acknowledging that while there are signs of potential bubbles, economic forecasts can be uncertain, and not all indicators necessarily mean a bubble will burst. The situation calls for cautious optimism, with an understanding that vigilance and perhaps strategic policy interventions are needed to manage these risks. The problem for investors is that it is difficult to know when the bubble will pop. If you get out too early, you risk missing out on large gains. If you wait too long, you may suffer a massive drawdown in your portfolio that could take years to recoup. You can try to mitigate these risks by timing the market or reducing risk. Market timing techniques include technical analysis and cycle analysis. Risk can be reduced by investing in assets that do not have a positive correlation with the stock market. These tactics offer a more active approach than the hold and hope method that a lot of investors adopt. In conclusion, we are likely in a speculative bubble, but it is difficult to predict when it will pop. You can try to time the market or reduce risk so that you maximize your upside while limiting drawdowns. Stay tuned to our channel for information on how to ride out these turbulent times.